But you mentioned, Mark, Fannie Mae and Freddie Mac.
Yes.
And that is obviously a term that a lot of people hear about, but they're
Yes.
not necessarily sure what those entities are. So could you go into a little bit of an explanation of what Fannie Mae and Freddie Mac are and maybe what the difference between the two are?
Well, Fannie Mae and Freddie Mac. Freddie Mac which is Federal Home Loan Mortgage Corporation, was originally created to buy loans from savings banks. Fannie Mae was created to buy loans from non-bank lenders. They're very, very similar. They have some small, subtle differences in guidelines. Like, for instance, Fannie Mae has a first-time home buyer moderate income product. And on a two-family, the minimum down payment is 15%. But with Freddie Mac, through that same program, it's 5%. So there's small, subtle differences, but essentially they're the same. And those are called conventional loans that go through Fannie Mae and Freddie Mac. They go through the FHA, VA, USDA, then they're government loans. And anything that's not a government loan, even if it's subprime, is considered a conventional loan. Okay, and Fannie Mae and Freddie Mac securitize loans and sell them on Wall Street, essentially. So they act as a conduit from lenders like us, or whether it's a huge bank like a Wells Fargo or Bank of America. We all close the loans and lines of credit and sell them to Fannie Mae and Freddie Mac so that they can be securitized, and those securities, which are bonds, end up in pension funds, money market mutual funds, and so forth. They're big dollar amounts, so individuals have to have big money to be able to buy those individual securities, because hundreds of loans get pooled into a security.
Yeah. Well, and this, I'm sure a lot of people are now thinking about, The Big Short, that movie, and the housing
Yes.
crash, and saying, well, wait,
Yes.
they're still doing this. And there is a very specific difference between what caused what happened in '07 and '08
Yes.
and what you're talking about, correct?
Yes, because back then they said, well, we'll create tranches of different quality of loans. First of all, those loans were privately securitized. So they went through Wall Street investment banks who securitized those loans, not Fannie Mae and Freddie Mac. And so they had A paper loans, B paper loans, C paper loans, D paper loans, all in the same security. And they thought, well, if these D paper loans go bad, we still got all those good loans in there, so it won't cause the security to need to be liquidated. But it doesn't matter. A loan goes bad, it goes bad. And the other issue is that these people who were creating these securities had no idea what was in them, and people buying them had no idea what was in them. So it was just a disaster waiting to happen, and we knew it. We just didn't think it would be as bad as it was.
Yeah.
So.
Yeah. Well, luckily, most areas of the country have recovered pretty much all. I mean, national average certainly has.
Yes.